Now let's apply the markup concept into the cost plus the pricing model to get the selling price, target selling price. We have the three different methods. First, the adding a desired markup, and second, individual pricing. And third one is pricing based on the target margin percentage. But anyway, we are using the same concept of a markup in dollar or in percentage. ABC Corporation produces an equipment with direct material at cost 25,000, direct labor and variable manufacturing overhead 600 direct labor hours times $30 per hour. Sales commission 2,000 and fixed cost 12,000. The company desires a 30,000 markup of total cost. So from the total cost, remember, what are the minimum and maximum target sales? Okay, we have all the cost information here along with this question, and then direct material is just we are given $25,000, and direct labor and variable manufacturing overhead we are using the cost per unit times the number of hours. So 600 direct labor hours times $30 per hour. We use 600 times 30 per hour. So 18,000 is direct labor and variable manufacturing overhead. And then sales commissions is given number $2,000 from the question. So total variable cost is just sum up. So 45,000 is total variable cost. You have to remember that in the contribution margin method, when the sales price is greater than the variable cost, then the company make a contribution margin, right? So we can accept any order, any special or additional order that is greater than this variable cost. So the minimum selling price the company can receive is $45,000. And then the fixed cost is $12,000, given number. And then added the desired markup, $30,000. Why do we put this $30,000 after the fixed cost? Because the company desires $30,000 of total cost. Is total cost, right? So this total cost is 45,000 and 12,000 plus the desired markup. So the sum of this total cost, variable cost, and the fixed cost and desired markup is 87,000 is the selling price for which the maximum selling price can be set up. Okay. So the method number 2, individual pricing. The case is the auto repair shop. And auto repair compiles separate categories of cost, direct materials, parts, and supplies, and direct labor. The manager then use the different the markup rates for each category. They use these rates to provide enough revenue to cover both indirect and unallocated cost and operating profit. The following is a format for a bill to customers. So, what is the total amount to bill to customer? We have two different types of cost. Auto parts, it can be deemed as the direct material. $200 cost plus 40% markup, and direct labor $20 per hour plus 200% markup. Oh, it has a lot of markups. Maybe it needs some more the supporting cost. So let's start from the auto parts. $200. That is $200, and then the markup of this $200 is 40% from the target cost of auto part individual. The cost is 40% to reach this the target bills is 200 times 1 plus 40%, so that we can set up these total bills. So in dollar amount, you can see the difference between this the bill amount and the target cost is 280 and 280, which is in a dollar amount, the markup in percentage is 40%. Direct labor, $20 per hour plus 200%. So just $20 per hour? No. We have to take a look at the direct labor in a total cost of direct labor, but the $20 is just cost per unit, one hour. So $20 per hour can be multiplied by 10 hours here to recover indirect and unallocated cost and provide for operating profit and the total billed for 10 hours. So $20 per hour. How long hours? $10. It needs at least 10 hours to repair. So we also have the target cost of direct labor, $200. It has 200% markup. In the same way, we multiply this $200 times 1 plus 200%. Okay, so the bill for the direct labor is the 600. So total bill to customer is just a sum up these two the parts, the auto parts and the direct labor. So 880 is the total bill to customer. Okay, method number 3, the pricing based on the target or margin percentage. An Italian printing company in Milan wants to price its job so that its one generates a margin of 28% of revenue. Okay, that is kind of a target costing. We use the gross margin, the cases. Here, compare the target margin with the target price with the markups. Again, we are using the markups. The materials $400 cost plus 40%. Again, we put $400 target cost and the markup percentage, or the dollar or percentage we are given is 40% markup. Then in the same way, the target price for this the material cost is 400 times 1 plus 40%. That is target price for the materials. Now the labor and the overhead cost is $18 cost per hour plus $7 markup times 30 hours. Then how to get this target cost? That's right. For the target cost, $18 cost per hour times 30 hours for labor. And then the markup. For the markup, how do you get the markup? So plus $7, they want to get more. So this markup is also calculated $7 times 30 hours. So this Italian printing company want to add this markup in dollar amount 210 from this target cost of 540. So for this, we just add this markup to get the target price. So total target cost is 400 plus 540, and then target price, the target price in total is, just sum up these two. Okay, so 1,310. Then let's calculate if the target margin is 28%, using the percentage setup, and we want to see if it is the right estimation. So how do we get it? Right, 1,310 minus this. Now we got the margin. Then divided by, which one do we need? 940. It is a different way. Totally, you have to be careful. We are not calculating the markup. We are calculating the target margin. When you calculate gross margin, how to get it? The percentage of sales. That's correct. So we are using this 1,310, the target pricing, the sales. So we got 28%, exactly same as the estimated, the target margin, 28%. Okay, that's it. I'll see you in the next video clip. Bye bye.